Artificial intelligence is transforming industries at lightning speed, and investors are taking notice. But you'll need to be a venture capitalist to get in on the action. Thanks to equity crowdfunding, everyday investors can now buy stakes in promising AI startups at an early stage. In this session, we'll explore how equity crowdfunding works, what to look for in an AI startup, and the risks and rewards of investing in this cutting-edge space. Today, we will talk about investing in AI startups via equity crowdfunding. So before we start, make sure to hit the like button and subscribe to my channel. 1. Introduction to equity crowdfunding and its emergence in the AI sector. Equity crowdfunding has emerged as a revolutionary investment mechanism in recent years, democratizing access to startup capital for both investors and entrepreneurs. Traditionally, early-stage investing was restricted to accredited investors, such as venture capitalists, angel investors, and institutional funds. However, the Jumpstart Our Business Startups (JOBS) Act of 2012 in the U.S. paved the way for equity crowdfunding by allowing non-accredited investors to buy shares in private companies through regulated online platforms. This shift created a new ecosystem where startups can raise funds from a broad pool of backers, and everyday individuals can invest in promising innovations. As artificial intelligence, AI, technologies have surged across industries, ranging from healthcare and finance to education and logistics. AI startups have become prime candidates for equity crowdfunding. These startups often promise transformative technologies, and with AI's momentum growing exponentially, retail investors are increasingly eager to participate in this frontier through equity crowdfunding portals. 2. The mechanics of equity crowdfunding in the context of AI startups. Equity crowdfunding platforms such as SeedInvest, Republic, WeFunder, StartEngine, and Crowdcube function as intermediaries that connect startups seeking capital with investors seeking opportunities. For AI startups, the process typically begins with the submission of a business plan, financial projections, product details, and a pitch video to the platform. Once vetted and approved, the startup launches a campaign where it discloses critical information such as the funding goal, valuation cap, investor rights, and the equity offered. Investors can browse these offerings and commit capital, sometimes as low as $100, in exchange for equity in the form of common shares, convertible notes, or SAFEs, simple agreements for future equity. For AI startups, these campaigns often include technical demos, roadmaps for machine learning model development, intellectual property strategies, and data acquisition plans. Due diligence, while more accessible than traditional VC, still requires an understanding of the startup's ad pipeline, the team's technical competency, and the competitive landscape. 3. The allure and promise of AI startups for retail investors. Artificial intelligence represents one of the most promising technological revolutions since the advent of the Internet. AI applications such as generative AI, computer vision, natural language processing, reinforcement learning, and edge AI have already begun to disrupt industries at scale. For investors, especially those without access to traditional VC channels, equity crowdfunding offers a pathway to invest early in companies that could be future giants. AI startups often operate in high-growth, high-margin sectors and offer scalability unmatched by traditional startups. Furthermore, AI tools and models can often be developed with relatively low initial capital, but yield disproportionately high valuations if they demonstrate a working prototype or customer traction. 4. Risks and challenges specific to AI crowdfunding investments. Despite the high growth potential, investing in AI startups through equity crowdfunding comes with significant risks. AI development is complex, resource-intensive, and often requires years of R&D before monetization. Retail investors must be cautious about hype-driven campaigns that overpromise outcomes without clear roadmaps. Many AI startups rely on open-source models or pre-trained APIs, from OpenAI or Google, which may not offer long-term differentiation. Additionally, regulatory hurdles, ethical considerations, bias in algorithms, and data privacy laws, such as GDPR, can pose risks to AI startups' scalability and compliance. Intellectual property (IP) protection is another critical challenge, especially when AI models can be reverse-engineered or cloned by competitors. Furthermore, the illiquidity of equity crowdfunding means that investors are often locked into their investments for years with no guarantee of exit or dividends. Startups can fail, pivot dramatically, or become zombie firms with no growth, making due diligence crucial before investing. 5. Due diligence. How to evaluate AI startups on crowdfunding platforms. Evaluating AI startups requires more than reviewing pitch decks and founder bios. First, investors should assess the technical credentials of the founding team. Experience in AI research, publication history in top AI conferences, EG, NeuroPS, ICML, and industry background in machine learning or data science are good indicators. Second, the startup's use case should be clearly defined, ideally solving a real-world problem with an identifiable market size and path to revenue. A working prototype, user engagement metrics, or early customer validation lends further credibility. Investors should scrutinize whether the AI model is truly proprietary or simply an API wrapper around a third-party tool. The quality and uniqueness of training data, the scalability of the AI model, and the startup's MLOps, machine learning operations, maturity are additional layers to evaluate. 6. Regulatory landscape and legal frameworks around equity crowdfunding and AI. Regulatory frameworks govern both equity crowdfunding and AI deployment. In the U.S., equity crowdfunding is regulated under Title II of the Jovius Act by the Securities and Exchange Commission, SEC, which caps how much individuals can invest annually based on income and net worth. Platforms must be registered either as broker-dealers or funding portals and are obligated to verify investor accreditation, disclosures, and financial reports. On the AI side, increasing global scrutiny over ethical use, algorithmic bias, and transparency is shaping how AI startups can operate, especially in sectors like health tech, fintech, and adtech. The European Union's AI Act, for example, categorizes AI applications into risk tiers and imposes strict requirements for high-risk AI. 7. Notable examples and trends in crowdfunded AI ventures. A growing number of AI startups have successfully raised capital through crowdfunding platforms and have gone on to scale their operations. For instance, Reverie Labs, an AI-driven pharmaceutical platform, garnered early support via Republic and attracted institutional follow-up funding. OpenCI, an open-source neurotechnology startup, used crowdfunding to launch brain-computer interface products backed by AI algorithms. Another case is Alethea AI, which blends AI and blockchain to create decentralized intelligent avatars and raise significant traction on crypto-centric crowdfunding platforms. These examples reflect a broader trend, the convergence of AI with other cutting-edge technologies like biotech, blockchain, and robotics. AI startups with dual-use technologies or platform-based business models tend to perform better in equity crowdfunding environments. 8. The future outlook, AI, crowdfunding, and investor empowerment. As AI continues to reshape economies and societies, the future of equity crowdfunding in the AI space appears promising but nuanced. On one hand, more investors will seek early exposure to transformative AI applications, whether in autonomous vehicles, legal tech, education, or synthetic media. On the other hand, platforms will need to enhance investor protections, standardize due diligence tools, and perhaps integrate AI-based analytics themselves to help investors identify quality deals. We may see the emergence of AI-specific crowdfunding platforms or syndicates where domain experts curate investment opportunities. Tokenized equity and blockchain-based crowdfunding might also intersect with AI startups, offering liquidity solutions and fractional ownership. Education and awareness will be critical. Retail investors must understand that while AI is a megatrend, not every AI startup is a good bet. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.